All right. Good morning, good afternoon, market scholars. Welcome to our options inventory trading class. My name is David Settle. Today is July the 18th, 2018. Glad to have everybody here on board. Today looks like we got some nice temperatures in different spots. Victorville. I know Victorville because I drive down to Southern California to go to Disneyland every other year or so. And yeah, I've heard that place gets very hot, very hot in Victorville, up in the high desert there. In fact, my favorite baseball team used to have their minor league team was there, and I've always kind of wanted to go, but apparently, like, it's insanely hot to go watch them. Something like that. Something like that. It's down 15, and then follow the Google Maps once you get down there, because once you get down there, it's like avoiding the traffic. Avoid the traffic. All right. Let's see what else. What else we got going on here today? There's a link. I didn't put it in the all participants. I talked about that, the buy the dips indicator. Buy the dips indicator from the market forecast class in technical analysis last Friday. I got a request for the link. I remember you can search for it in the forums. Just search for buy the dip. You have to scroll down a little bit, but I just posted a link to Curdy Scan, the Curdy Scan there to be able to find that. Easy. The searching from the forums got a lot easier since we've added on this new social network plugin. It's kind of made things look a little bit better. Hopefully, also you've noticed that you can change your profiles and now like crop in on your profile. So that I'm sure that helps. Hopefully that helps you there. All right. Well, and today for us, so I'm going to be getting done probably about 11, right when we get finished, right at the top of the hour. I have, today is See the Light Day at our house. My wife, who is blind as a bat, without glasses or without contacts, I mean, she really cannot see anything unless she's got her contacts in. She's getting LASIK surgery today. So this is something that we've been kind of planning for a long time, before I left the previous employer, but we had been saving up and we finally are taking the plunge before she starts teaching. So if any of you have any tips on recovery from LASIK surgery, if any of you have gone through that, let me know, because this will be a new thing for us. That was exactly my thought there. My thought was, the exact thought I had was, wait a minute. I've benefited all these years from the fact that you've been blind as a bat, and now you'll see me in my real light. All right, let's hit these disclosure slides. I remember this class is for educational and informational purposes only, not considered to be financial advice. Everyone has personal responsibility over their trades. We do know that you take some trades that we teach. I had some people tell me that they take all the trades from the Market Outlook videos. So I understand that. Just know that that they're not intended to be advisory. They're intended to be examples for what I want to teach you. Doesn't mean you can't take them. Just everybody's got personal responsibilities, and there's no guarantees, right? We teach through application. If you don't trade, then you won't learn. So we're all for that. We're definitely all for that. Thanks, Jason, for that. Appreciate that. Yeah, we're hoping it works well for her too. We're hoping that she can now not have to wear those. She's got some pretty heavy-duty contacts that hopefully she won't have to wear anymore. There's a risk of loss in trading anything. Consider all relevant risk factors, and past results are not indicative. Yeah, this Brandon's class, he's got quite a few winners from that class over the long term. So, you long time Brandon Van Z followers, you've definitely been rewarded during this bullish run the market's been on. That's for sure. Of course, a lot of stocks are going up, but not nearly to the extent of some of the stocks that he's been able to highlight in his classes. So, yeah, I tweeted out today that there seems to be a lot of congratulations going around to you longtime followers, VVZ disciples. You've had a good run here, a good run. There's a lot of good companies, and we expect that you will continue to have a good run going forward here from now on. All right, nice. All right, well, let's go ahead now and put a lot of pressure on him now. And me, for that matter. Let's go ahead and take a look at what's going on in the market. So bear with me 1 segundo while I bring this up. Here we go. And I'm going to bring my chats over here. 1 second. All right. Yeah, the link, Steve, should take you to the Market Scholar site. It should take you to our forums. So it's a scan that you can import into your platform based on what we talked about on Friday. Okay. Sure, Ashwin. Just send me an email there. Just send me an email. Let me know. All right. It took me to the discount. You might have to log in. When you click on that link and it takes you to that page, does it say in the top right corner log in, or does it say log out? So it might take you to an unlogged in page that you might have to log in again to get to. Yeah. Yep. So click on that login. Log in again, and then it should take you to that page. Look at what we got going on here. It's a red dot. What's that red dot? Weren't we supposed to be like in bear market mode right now? Like over here we were like heading down, and then, Monday, was it Monday? Yeah, Monday, things were looking pretty bearish, and then like at the open yesterday, again, it's eerily quiet on the Twitter direct message front. We're getting this red dots. That's not bearish. That's why we changed the name with the good feedback from I can't remember. I think it might have been Van or somebody here. One of our market scholars. Good. I'm sure a lot of you probably thought the same thing. But good feedback to change the name of those signals. It's not a bear. This is not a bearish cluster. It is a cluster. It's an overbought cluster, but it's not a bearish cluster, because a bearish cluster implies that it's going to turn back down, and that's not necessarily the case. You can see when the intermediate line when you get a bearish cluster at the beginning of an intermediate run, that's almost like a confirmation. That's almost like, okay, we're in it. We're in. Now we might get a near-term pullback, like we did here, and that's kind of what I'm expecting eventually here. I even have the target, for where the near-term pullback could go to, based on the divergence that's setting up. But that doesn't mean, if we get a near-term pullback, doesn't mean that bearish cluster played out, right? It just means that the near-term line pulled back, which is what you expect it to do every 7 to 12 days. All right, so yeah, you get a cluster. Now, if you get a cluster at the end of a multi-month run, which it's crazy that we never got one right there on that day. The near-term line didn't quite get into the reversal zone. It was actually coming off of a divergence there. So it didn't quite get up there. But still, that was about as divergence of a cluster of a day as you can get. When you get a cluster at the end of a multi-month intermediate run, then you start worrying about it being a little overbought, right? And then you start saying, okay, let's peel back some risk and reduce our positions and look for an intermediate pullback, not just a near-term pullback, but an intermediate pullback. And so, we're getting a cluster right now. Now, granted, it's not the end of the day, and so as much as, we talked about yesterday, that the closing price matters a lot more than the open. The open was really bearish, and so the closing, we ended up really bullish. It's the same thing applies today. Like, the closing price matters a lot more. We're kind of bullish right now. We could definitely be bearish by the end of the day. So, it's the closing price that matters a lot more than the opening price. But as of right now, if we were to close at this level today, right now, we'd have this overbought cluster. Overbought cluster towards the beginning of an intermediate run. So it's almost like, the market forecast is giving you the stamp of approval on this intermediate rally, that there's a good chance that it will make it, that will make its 1 to 3 months, run, and probably around the 2-month area. Usually you get your longer intermediate runs early in the market sentiment rally, like the first one. The first one actually didn't last. I kind of expect we'll get more frequent intermediate runs. It'll be a little bit more volatile during this market sentiment rally compared to the last one. So probably about 2 months now, considering that we got this cluster. I don't think we'll get to, of course anything can happen, but I don't think we'll get to 3. But with this cluster, I do think that we'll pass, even with the seasonality that's expected to show up here after this month, after this week, excuse me. I do think that we'll stay bullish enough to avoid significant pullbacks, like intermediate pullbacks, during any seasonal weakness that we may have. Yeah, if I'm on 4B, it looks like, if that's what you're talking about, Bill. 4B. So I do the 4 grid. This chart, 4B looks like this normally. But I start off on your charts, but I usually start off with it full screen. So this is what so what I did is I opened up the S&P, and then I saved the grid, and I overwrote that, and so now when I click on 4B, and usually 4B doesn't have the implied volatility, it looks more like this. Then now whenever I go to 4B, it pops up this, and I can just flip through as needed, right, with these arrows up here in the top right corner. MKC, are you talking about the market or the symbol MKC? Yeah, that I don't know about McCormick. I just know that the S&P 500, looking at its seasonal charts, typically it peaks at July expiration and bottoms out in October expiration. So from July to October expirations, the S&P 500 is pretty darn weak. Style, seasonality, and then we'll change this to show price as percentage. Okay, and then let's go back 20 years, get some more data. Okay, so from here, here it says July 18th. It's on average is about wherever the July expiration is. From here to a little bit before October expiration is a period of weakness in the markets over the last 20 years. Right now, as you saw in the last 5 years, it hasn't been as stark. Right, so here you still got the same peak, and then there's that same bottom. So it's not as deep a correction, and most of it occurs in August lately over the last 5 years. But longer term, that's what it looks like. So so we've had this period of strength from early February. We usually get some weakness in January, but this year, it was crazy. But usually we get a round of strength from early February on up to now. And we've actually had. Look, we've gone from we started early February with a minus 4.3% drop, and we're currently sitting at a 4.4% gain. It's a pretty decent return during that seasonal bullish run, right? Seasonal bullish run there. Yeah, you can definitely use SPX and run the safe commissions. I'm going to use SPY here in classes for A classroom setting is a little bit easier for everybody to use, but yeah, and you can definitely use SPX or RUT to save commissions. Just take into account, Bill, that you'll have wider spreads because of that, and you'll also, because they usually don't have dollar-wide spreads, right? Because SPY is SPX divided by 10. So take that into account. You'll have wider spreads usually, and then you also have wider bid-ask spreads on SPX, which when you're trading an iron condor, for an example, can really be a wide spread. So just take those into account. Do you ever weight your iron condors based on seasonal patterns like we were entering? No, not necessarily, because, Joe, I'm always entering iron condors throughout this period of time. So I remember this style of trading actually does better when we get pullbacks. Volatility rises. We can trade calendars during this kind of a thing, during this kind of a run. Remember, this, like someone was saying, what was it in Victorville? It's 86 degrees, which is like not, it's usually like in the hundreds, right? So maybe that's not the case, but just because the almanac says that this should be the hottest time of the year, doesn't mean that we might not get a few cold fronts and we don't get what we expect, right? The temperatures might be cooler, or like for us, we expect to get, a lot of precipitation over the winter, and lately we haven't. So we haven't, like last winter, it was like spring until March, and we finally started getting some snow in March, but March snow is a little bit different than January snow, so evaporates quicker, so we don't get as much water. So you get the idea. You have the almanac that gives you the expectations, but that doesn't mean, which gives you the environment, but it doesn't mean that things have to work out that way. So, it's not guaranteed to go down over the next 3 months. There's a good chance it will, because that's typically what happens for whatever the reasons are. A lot of people take the summer off. We're going out of town at the end of July. I know a lot of people in August start to go out of town. That's kind of the, I have family coming over on vacations from overseas in August. So, we have, this is the time of year for people to kind of shut it down. And then, September and October, I don't know for what reason, but that's usually kind of a bearish time in the market, especially at the beginning of October. There's usually some crazy things that happen when people come back into the markets. So whatever the reasons are, that's just the seasonality of it all. And so we can't, as an inventory trading, we just trade the moves. We don't care about, anticipating a direction. That's more for directional option strategies. That's more for trend trading. That's more for our portfolio and how we tilt and all of that, right? That's more for all of this stuff. For this style of trading, as we move, we just place trades, and we just trade small, and we just take advantage of the moves up and down. And as we move down, as we anticipate moving down, then we could add calendars into a trade, looking to take advantage of lower volatility, which during this run right now that we're on, I've talked to you before about how important volatility decisions are. That's kind of what we talked about in our last class. We haven't been getting very many big volatility days since last week. But you can see we also haven't been getting very extreme lows on volatility either. We are down below 12, which we haven't been, since what, June. So it's been a couple of months since we had this kind of run up in volatility. But you also notice even during this whole year, last year we spent weeks, because this is a daily chart. We spent days and weeks with volatility being below 80% of the 3-month VIX, which is VIX 3M. It used to be VXV, the popular ratio that most of you know that I like to look at. We were below 80%, which means that 80% is the extreme low point, right? When it gets below 80%, that's when we know volatility is at extreme low, and you notice when volatility is at an extreme low, it typically bounces on a relative basis, but also bounces on an absolute basis. last year was so anomalous, and how low volatility was for so long. This is kind of more normal. And in fact, here, let me show you, because this one-year chart only shows you this crazy period. Let me show you a little bit more of a reality. So here's, look how low it was for all of 2017. Brief, spikes in volatility up above 1, buying opportunities, in the markets. But you notice most of the peaks came right up to the reversal zone. So here's another one. So we had 1, 2, 3 spikes. All the rest of the moves pretty much petered out at below this brown range. Now, I'm on 4N for those of you that are following along. This brown range, which is the neutral zone. When the volatility is in that neutral zone, that's below it's bullish and above it's bearish, with these market scholar colored lines here kind of being the sweet spots in both areas. So you can see how bullish we were and how we never really got even bearish except for brief periods of time. Well, now you look at this year and you can see we spent most of this year in the neutral zone or the bearish area. We haven't spent very much time at all with volatility in the bullish zone until lately, until the summer, spring, and then especially in the summer. We didn't even get below to lower half of that sweet spot until now. So, look how we've avoided extreme lows. That's why we haven't really been doing any calendar spreads on these trades, because it's we haven't had extreme low volatilities really to take advantage of it. Big drops in volatility. Our drops in volatility have been kind of steady, steady eddies. All right, so let me go back a little bit further because you can't really see 2016. So here's 2016. So 2015. Remember when the markets were really bearish at the end of 15, beginning of 16, right there during that time frame. Look at how we rarely got extremely low for most of that period. In 2016, things changed, and that kind of held for all of 16, heading into 17, really, really low volatility levels. And you can see we're back to this kind of mode here. So when you do get the drops below 80%, you can see like here in December of 15, when we drop below 80%, it can spark a rally in volatility. Okay. Spark a rally in volatility there. Yeah. So so that's kind of where we're at, from a market posture perspective. Yes, we are expecting seasonal weakness to occur, but kind of an asterisk with that expectation is we are just starting an intermediate run. See, let's go back a couple of years. So here's July. So remember how we typically spike in the middle of July, so that's about right here, and then we have weakness till the middle of October. Man, I can't talk. Got this frog. So to kind of reinforce the idea that the weather isn't always what the almanac says it's supposed to be. Here's the middle of July, where we actually got a red dot back then too, in the middle of July, and it actually did form an intermediate weakness into the middle of August. But by October the 11th, when we were supposed to bottom out, that's where we were. So it's actually higher than, a lot higher than that peak in mid-July, whereas on the seasonality chart, it's a lot lower. So, grain of salt there. We're pretty bullish here. Now that bullish cluster, that overbought cluster, excuse me, kind of the market stagnated after that with the seasonality weakness, and that's kind of what I'm expecting. I'm expecting kind of worst case scenario here, seasonality weakness, to not necessarily push us lower, to a steep, decline towards mid-October lows. I'm expecting a worst case scenario that we kind of flatten out, if not grind slowly higher to finish out this intermediate run. See, this intermediate run lasted about a month. You know, we got up here mid July, and we petered out finally in mid-August. So it lasted about a month there. So, you know, I think we could go a month to probably 2 months on this one. You can see how we didn't have that much of a dip there, and you can almost argue that that was one big intermediate rally here that lasted multiple months. And this is more towards the end rather than the beginning of an intermediate run. The red dot is a cluster, so it's all 3 lines above 80. Green dot, you can see over here, is a cluster with all 3 lines below 20. So it's an oversold cluster. Red dots are overbought clusters. Green dots are oversold clusters. I think I brought that up in the market forecast lesson, not the last technical analysis class, but the one before that. I spent some time on clusters and what they mean. I've talked before about how clusters have this misconception that they're immediate reversal signals, and the reality is that they're not. I mean, you've got a strong bullish, right now, we have a strong bullish posture on the green line, and we have the near-term line confirming it, and the momentum line is spiking to an upper level. So, like, how bearish would you want to be right now in that environment? Strong bullish posture with short-term sentiment confirming it. I mean, it doesn't sound too bearish to me. Now, we're overbought, and we might, like I said, get a near-term pullback, and it definitely could signal kind of an exhaustion move at the end of an intermediate rally, but like I said, usually it's a stamp of approval at the beginning. Usually it's a stamp of approval at the beginning. I am actually producing a tutorial for this. I just haven't had time. A lot of back office type stuff I've been working on here lately, but I am working on a tutorial for the market forecast, and it's a technical analysis class session. The last 2 technical analysis sessions I've spent breaking down the market forecast indicator. Last week were trade signals based off of it, and the class before that, which is a couple weeks prior, we broke down how the indicator works. All right. So with that being said, let's take a look at our July inventory, because that's, you know, expires this week and expires in a few days. Now, I wanted to keep a lot of these on because I wanted to talk to you about it, about this run that the S&P's had the last few days, really since this move last Wednesday. Since that move, things have kind of bounced up. So I wanted to talk about how that impacts our inventory. All right, so let's take a look at, here we are, July inventory. Okay, we'll pop this up. So you'll notice that, of course, the SPY is impacted by far the most. If you take a look at you see there's a lot of ITM tags. Let's take a look at the options chain. We'll pull up SPY and get rid of these for a second. Give it a second to load up. Eventually. Hey. Oh, there we go. All right. So, look at that. Look at those volatility levels. That's just anemic. That is unbelievably anemically low volatility. Now, it does bounce up a little bit here in August, but man, insane. It's insane. And we're in earnings season right now, and all the headline risks that just seemingly come from Washington, especially, and the market just was like, you know what, we could care less. And you can see a lot of markets could care less. The high yield market could care less. The investment grade, the mortgage-backed securities, small cap stocks, growth stocks, they're all just flat as a preferred stocks, all flat as a pancake. And real estate's the only mover to the downside, sharp mover, and crude oil and related assets are really the only big movers to the upside today. A little bit of a move in value stocks, it looks like. All right, go back to SPY. For the most part, the market's usually right? Because the market is apolitical, Tom. The market is apolitical. It could care less about the party involved or what they're doing or how stupid they are or whatever it is. The market just cares about economic expectations and earnings expectations, right? So that's why we always talk about, any kind of headline that comes out, does it impact earnings expectations? Does it impact economic growth expectations? Does it impact earnings growth expectations? And for the most part, it's no, right? And we can get a pretty decent idea from the markets that it's a no. Now, eventually the markets will get too one-sided. And that's, like January. Remember how in January, in a lot of the market outlook videos, it was, we were just like, this is too much. Take risk off, and it just kept going up. Like every video, it kept going up, and it's like, it was insane. And so, eventually it obviously did correct itself. So eventually the markets will get too one-sided, but right now I don't think that we're too one-sided. Yeah. Yeah. Especially the bond market. The bond market's another thing. And the bond market does say to anticipate a recession, right, with the inverted yield curve. The problem is that recession usually comes, what was the data? I retweeted this out from Ryan Dietrich. The recession, after the yield curve inverts, the recession usually comes, or at least the stock market peaks, almost 2 years later, right? The last 4 times, the last 5 times we've had inverted yield curves, the S&P 500 peaks 19 months later on average. There's your months to inversion. There's a couple that are a little bit quicker, but for the most part, on average, that's 19 months with a 22% move. Even those two had decent rallies in those short terms. So, the bond market has even a lot more money coming into it than the stock market does. And the markets are always about pricing expectations. They're always looking forward and pricing expectations. They're not reacting to headlines like you and I do. It reacts to headlines in terms of how it impacts their expectations going forward. All right. Come back over here to our SPY. I'm going to change our layout to the one that I've got saved here, position delta extrinsic value. We have to scroll down to see, oops, that's August. Let's go to July. All right, so you notice all of these, so I'm looking for red tags. Red tags are my short contracts, green tags are my long contracts. And let's add them all up on the put side first, and we'll take a look at the call side. So we got -3, -9, -12, -14, -19, -20, and -21. Now really quickly before I do that, you notice that we are down a couple $100 on this inventory. Like the SPY is down a lot, but IWM's up quite a bit. So in total, we're down a couple $100 on this inventory. Now, if you recall, if I do a beta weighting on this for all the July inventories, and let's get rid of, let's delete simulated positions here, delete simulated trades. Okay, what am I doing wrong here? No, high, I don't want a high position show all. There we go. And July inventory, beta weighted, and that's not the picture I wanted to see. So I'm missing something here. There we go. All right. Just make sure I got everything the way I want it. Everything's checked off here. I don't have any zeros checked off. I can throw things off. Okay, I think we're good. All right, so you can see that my worst case scenario on this, and this because there's this calendar going on, and so we, I'll take a look at that here in a second. You'll see the calendar going on when the numbers don't add up. But the worst case scenario to the upside was $6,000 of risk, essentially. See, I'm looking at the green number here. $6,000 of risk was my worst case scenario. I did some, Bill. I wanted to wait to close out any trades until this class today to talk about it. $6,000 to the upside. That's my worst case scenario. Over here, it was $12,000. And remember, the most that I want to have in any one inventory is half of what I'm willing to allocate to this style of trading in my active trading account. So for those that are new, we're using a $100,000 active trading account, hypothetical active trading account, which is a portion of my total portfolio, a $100,000 active trading account. We're dedicating 25% of it to this style of trading, so that'd be $25,000. So half of what I dedicate, $12,500, is the most I want to have at risk in any given inventory, right? And you can see that easily just by looking at these, the green line in either direction. Now remember, we unbalanced the IWM condors to kind of show it, and we're still doing that in August too, to show the difference there, the distinction, and the benefit. See, it gives up gains but lowers the risk to the upside, which we're really benefiting from right now, actually. But the reward potential was there, a couple grand, which is about 30% of my risk to the upside, and of course, we weren't nearly as worried about risk to the downside, below 260. That's way on down here. We have big time support holding us up there. So not as worried about the risk to the downside as we are to the upside, and we're down 200, so 12,000 bucks. My worst case scenario, if I were to go to Caribbean and forget about life for a while and come back on expiration day and the markets just plummeted. That's my worst case scenario in this environment, in this position, this inventory. I would lose 12,500 bucks. That's what I've got at risk. And right now, considering the market's going up, which is, the worst thing that this style of trading performs the worst in, you can see, because we've unbalanced some condors and we've placed positions on bigger moves, days where there were bigger moves, a little bit higher volatility. We took advantage of the spikes in volatility. We got some decent premium because of that. So with all that said, I'm down 200 bucks. 200 bucks. So to kind of give you an idea, it's 1% of what I had at risk on this trade. And the most that I could get was 2,000 bucks, and it's a 10-to-1 reward to risk ratio. A 10-to-1 reward to risk ratio there, considering now that this is end up what we're losing. And remember, because of, yes, that's what we're going to talk about today. So because of, because I'm losing here, that means I'm not losing elsewhere, right? The margin account, the swing trades, have been doing well for this month. The trend trades have been doing well so far, doing good today. Of course, the portfolio management's doing better. It's up, a few thousand bucks. Most of that coming here recently. So, am I willing to give up a couple $100 bucks, a tenth of what I was trying to make in loss to get the returns in the other areas of my portfolios that I got, right? That I got. So, that, to me, the answer to that question is yes. Sorry, I was reading the question in the chat window. The answer to that question is yes, because, that's the point of this portfolio. That's the point of this style of trading, is to provide us some return when the markets aren't doing anything, to give us some of a hedge when the markets go down, because this does pretty well when the markets go down. And when the markets go up, if I can limit my losses to this minuscule amount, and give up a small loss for returns I'm getting in my other segments of my portfolio, great. And if I can keep my reward to risk ratio, to a couple $100 like this of loss for the couple $1,000 worth of potential reward, then that's pretty good too. All right, that's pretty good too. All right. So I do post out in the forums after every class. I post out the trade that we make in every class. So so that this class, these are examples, right? And if you're going to mimic this portfolio exactly, then you're going to mimic a class portfolio instead of trade. Because you notice I haven't been able to do a whole lot of trading in between classes because I've been busy with other things, and so I've been using the classes to be able to make trades and educate through the trades. But the reality is, you don't have to just wait for Wednesdays to make trades. And I know a lot of you don't, because I know a lot of you are using what we're teaching in these classes to make trades in the other days too, especially when you have the decent moves on days that are not Wednesdays, and you take advantage of that. And so keep in mind, if you trade this portfolio exactly the way I do, then you will be getting a class portfolio instead of your own portfolio, right? And all the advantages that you have, since you don't have to only trade on Wednesdays. All right, so that being said, let's take a look at SPY. So let's start off, let's go back to counting what we got here. So what was it? Was it 21? Minus 3, make sure, okay. Minus 3, minus 9, minus 12, minus 14, minus 19, minus 20, minus 21. Okay, so 21 negatives, and then 5, 8, 11, 17, 20. 20 positives. What does that mean? 21 negatives, 20 positives. What does that mean? Potentially, it could be a strangle too, right? But let's see, is there a positive that's a dangling positive here in the August? And yeah, there it is, at 275. So we do have a calendar or a diagonal. It could be either one, but we happen to have, still have a short contract at 275. But regardless, it's a calendar is, the August doesn't matter. It's this one that matters the most. And you notice that they're all now below 5 cents. So I can close out all of these, not the positives. I don't have to close out the positives. They'll expire worthless. You probably can't, you can get a penny for that one. And all the rest of them you can't get anything out of anyway. And you don't get commission savings on those. But all these negatives, we can buy back and close these out. So we'll quickly do these. And this was 6. And this one was 3. And this one is 2. And this one is 5. And this one is 1. And this one, my calendar is 1. Okay. Now, I do have to close out that August, so I'm not going to let it expire. So I'm going to close this out. I'm going to buy this one. Actually, no, I'm going to let this one I'm going to actually leave that in, the 275 in. I'm going to come out here, and I'm going to close this out. Okay. Hey, yeah, thanks. That's right. That's true. Forgot about that. What Brandon's saying is I can just do this. Excuse me. Create closing order and buy him back. All right, so let's come back over here to the call sides. So that's the put sides. So everything else expires worthless, nothing to do there. That one expires worthless too, so we'll just leave that there too. Over here, I've got, let's see, 9, 12, 14, and is that right? Is there any more? Oh, that's it. Okay, so 9, 12, 14. Okay, 14. Just making sure. I was up late last night. I was up to like 3:30 working on stuff, so my brain's a little bit fried. All right, so we got 14. Why do we only have 4? This was balanced. We didn't do any unbalanced in SPY. So why did we only have 14 negatives and 20 without the calendar, 20 negatives over here? Let's see, how many pauses? 6, 11, 14. Okay, so no calendars on the call side, just on the put. What do you think? Why did we have 14 negatives over here and 20 minus the calendar, 20 negatives over there? What do you think? Aha, look what Arts typed in the chat window, everybody. The risk was the same, right, Bill? Remember on SPY, we're balanced. So the risk was the same in either direction. The difference is the strike width, right? The strike widths, remember how these are all, 50-cent wide spreads. You just don't see the positives in here because they were pushed out, right? A $2 wide spread, like Art says there, a $4 wide spread is for $1 wide spreads, right? Or you don't get to dollar wide, so you get up here, but or it can be 8 50-cent wide spreads. The point being is we might have closed out some negatives by putting in the positives and pushing things out, right? So that's things can get adjusted based on how you're entering trades and how wide those spreads are over the course of an inventory. So that's why I like the Analyze tab, right? You don't see that now because we've just closed out all those trades. But if I were to just look at SPY, if you recall, yeah, and say I've got nothing but long puts up. But the risk was 65.71 over here. It was 65.71 over here too. Okay, that probably did close some out, but you get the idea. You get the idea. I don't think I closed out 6. The point is that you can move things around, right? You can move things around by putting in some long contracts here or some short contracts at long and move those longs out. Things can get adjusted. Okay. Eventually, if you were to add up all the dollar-wide spreads, for an example, versus all the dollar-wide spreads over here, they would all be equal if you have the risk equal. If you have the risk equal. All right, let's get rid of the easy ones. There's only one easy one because that one's not there yet either. So let's get rid of, and actually, you know what? That one's not, we're still waiting because you have to buy it back for 5 cents. Right, to get the commission savings on this platform. So right now we're buying it back for 6 cents. We have to wait a little bit of time to close those out, to get those out. And you got these that are in the money. Okay, what are the odds that by Friday these options will roll back below the stock, will drop back down below 278.50, which is, to give you an idea, there's 278.50 right there, essentially, right there. And then 278 would be right there. So it doesn't look very far away. What are the odds? Very low probability. All right, very low probability. Now, typically, see, back, a week ago, these were fine, right? A week ago, we were trading, let's see, over here on Wednesday. We were back below 278. So things were fine. Yes, we'll have to close out the longs too. That's why we didn't do anything with them a week ago. They were a little in the money there, but they still had, a week left a week left to go. So they still had a higher delta. In fact, here go to analyze, think back, and we'll go back to, when was that? This was the 10th, so the day before our class last week. And this would have been, here's expiration, so 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So 10, 11 days to expiration. All right, let's go, it's right there, 11 days. And move this down. There we go. That's what I wanted to do. And it was 278. Remember, 278. The heck? Here we go. Wrong year. All right, 278, 10 days. That's right, isn't it? Yeah, Tuesday. There we were. So you see, the deltas weren't so bad then. The day before, once we entered the exit window, which is, 4 to 10 days, and once you're inside that 10-day window, now you're inside the exit window. Your entry window closes 20 days. Your exit window starts to open 10 days before, when you really start closing out this inventory. So at that time, things were fine. There was still a decent probability that we would come back down and close below 278. And you see the next day we were. The next day, here's 278. So just like that, things were fine, and there was nothing to do. Everything was out of the money. That changed the day later. Right, the day later, you can see now we're back up into that 60 area for both of these. And what you start to do then, you start to say, okay, how much am I down on those verticals compared to, again, how much I'm trying to make on the inventory as a whole to know when do I cut. When do I cut once I'm inside that 10-day window, once I'm inside that 10-day window there. If you notice, this was the next day, on Thursday, the day after when things bounced back up. Even then, you still had a pretty decent, it's 60% or 40%, but you still had a pretty decent chance of closing below. In fact, we were just barely above 278.50. That was that's this one. That's where you have, we have 3 contracts at 278.50 and 6 at 278. So you had the bulk of your contracts there, and even then, you were still fine for us to close within that area, that gap. But now as things rise and the market continues to bounce like we did here yesterday, this was the big red flag to me that we weren't going to be able to make it. You can see even as of Monday. Go back to Think Back tab. Even as of Monday, I was actually still okay. It's not showing. It's not letting me go to Monday. It's not giving me the Think Back data. But if you notice, on Monday we were trading at. We closed at 270. Here we go. Yeah, 279, 279.35. And then you can see, where, we opened up the next morning at 278.41. So that's how close we were to being back out of the money for at least some of those strikes, some of those strike prices. This is the big red flag that told me to get out of this trade, because now the deltas are to a point where they're too high. There's still a chance that these can close out of the money, but not as high a probability, right? And how much more can I lose on these? So you can see they're at, if I were to say, let's say I were to pair those 6 up with these 3 right here, because you can pair them up with any. You can pair them up with any long strikes. I'm going to pair them up with these 3. So I'm going to sell this, or buy this one back, and I'm going to sell this one. Okay, so it's going to cost me, and for 3 of these. So for 3 of these contracts, which are $2 wide spreads, you can see I can still lose 26 more cents. The worst case scenario is to buy them back for $2. I can still lose $26 times 3, $75 on this. And then of course the other one, the other 3 would be buy this one and then sell this and do that for 3 contracts. Okay, so the worst case scenario there is $2.50, and so I can lose $42 times 3. So I can still lose quite a bit. There's a pretty good significant change with the gain reward potential being $209 times 3 and $175 times 3 with a low probability of getting that. So in my opinion, these I'm done with, and I don't want to lose. The market's still bullish. I expect it to be bullish heading into expiration. Of course, anything can happen, but those are my expectations, and so I don't want to take the risk of losing the rest of that. Now I've got 270. Yes, that's right, 278. Now these are for the 278s. These are for the 6 contracts at the 278s, right? The 278.5, that's a different story. So I buy that back. I've got to find 3 contracts somewhere. So I can find those anywhere along these positives over here, right, to buy back those. So, if I were to buy that back, sell, and I've got to have a bid, so I'll sell one of these. I'll sell 2 of these. So this will be 2. And then this one, I will buy that back and sell 1 of these. So there's the 3 contracts at 278.50. And you can see the worst case scenario to buy those back is a lot more. So I've got a lot more risk here. I'm buying them back for 263, this one for 264. You can see the worst case scenario is a lot bigger. Okay. All right, so I'm going to actually just send all these through and close all these 9 contracts out. And here's all 9 of them. The 6 278s and the 3 278.5s with accompanying long positions here. And I'm going to get rid of those long in the monies. And then a few of these long out of them. The rest of them we're just going to let expire worthless. So we'll hit confirm and send all those through. So you notice I did a blast all, which basically puts all these trades out there. See, there's one of them failed and the rest of them are right there working. They're all just individual trades. It was like one big ticket with multiple trades on it at the same time. That's what the blast all does. All right. That's SPY. We're done now with SPY. Now, like I said, I would have done this yesterday, but I wanted to wait till this morning to show you and talk about it in class and show you kind of how to find the longs, how to figure out where your losses are and all of that. All right. Yesterday, the reason why is because we had this breakout. We started off okay. In fact, I was fine. I was fine with that drop yesterday we had at the open. We started out okay. It was the rally, especially breaking up through these highs, that really changed things, that, this SPY was in the money. And it's not like I was concerned about a couple $100 loss. Not concerned at all about a couple $100 loss for a month's worth of inventory, considering the gains that we've had in other places. All right. Yeah, if that's what brings big rewards in other areas of our portfolio, I will definitely do that. There we go. It looks like they're all filling. So now the rest of these, 5 and 5, are all out of the money, and we'll just buy these back when they get to 5 cents. These will lose their value. Remember, calls lose their value a lot faster. Calls lose their value a lot faster than puts do, right? So these will lose their value a lot quicker. And we'll just let that one expire because that was the calendar spread. All right, and these will expire worthless too. So let's go now to IWM. All out of the money, right? So let's go to this, count them up, 4, 6, 12, and then 12. So all vertical spreads and all the negatives, except for these still, are to where I can close them out. So I'm going to do what Brandon said and create closing order and close that out. And I'm going to right-click on that, create closing order, close that out. And right-click on that, create closing order, and close that out. Okay, there we go. Ooh. No, that's not what I wanted. The heck? I spent some commissions there by fat fingering something. Now I've got my 4 that I have to deal with eventually. They hold their value. I'll probably end up dealing with the calls on SPY before I deal with these two. These hold their value better. All right, so now let's go over here and let's see. Can I buy? Let's see, what's 4, 13? So I had 13 over here and 13 on this side. So this one, these I can get rid of. So right-click, right-click. Why is it doing that? I don't want to. Am I double clicking or something? All right, there we go. Let these expire. That one I still have to do something with. Like I said, I'll probably have to deal with that one and close it out faster than these because that 9 cents will get down to below 5 faster. That was easy. IWM was easy. Now we've got a couple others though. We've got, so IWM, SPY, we have TLT. TLT has got some in the money contracts. So let's take a look at that. Why close for only 2 days? Because 2 days, I don't want the risk of what can happen between now and Friday. Ashwin, you're talking to somebody through experience that has had a trade close Thursday trading at 99% chance of max gain. Close Thursday at 99% chance of max gain and open Friday trading at maximum loss. Right? So I'm speaking from experience on that. That was real trades. It was a real case scenario. I closed, like I said, Thursday the market closed, and I was at 99% chance of max gain in my trades, on my verticals. Friday, by the time the market opened, I was at maximum loss. Anything can happen. Anything can happen, and I'm not willing to take the risk. Because that's all those verticals have left in them. There's no reward left in these verticals here. Right? There's no reward left in that. The only thing I have left is risk and anything crazy happening before expiration. That's all I've got left in it. So I'm getting out, closing out of my risk on that side. And I'm making sure I'm not double clicking it. I think that must be what's going on. So there's nothing there. Here I do have some risk. So again, Look at the odds. What are the odds? I'm going to buy that back. Here's my 3 contracts, which I can't even sell. So here, this is why I got to have some cash. I can't sell that spread. I can't sell this spread. It won't take for me. Right? This trade, if I put this in right now, it would not go through. And you'll be wondering, how come I can't close out of this? Because it won't go through. Right? You have this no bid to sell these at. So that spread will not go through. So you just have to buy this back. The short contracts themselves, buy themselves. And that's why you make sure you have to have some cash. Now you notice they're at $1, and you know what's the highest price that can get up to? What's the highest price that $1 can get up to? Unlimited, infinite. So I'm closing out that risk, and you know that's even more risk than normal. Technically, I've got those 3 contracts. So technically, the most I can buy that vertical back is $6. That's the worst case scenario. Right now, it's only $1. I'm willing to take $1 out of a $6 loss, so I'm going to buy those back. We'll see what we can get. No, it failed immediately. So we're done with TLT. And then XLE was our last trade. XLE is our last trade here. Out of the money, and we can buy those back. And out of the money, we can buy that back. Oops. And there we go. So we are done, with a few exceptions. We are pretty much done with July. There's a few short contracts that are out there, right? So on IWM and SPY, there's a few short contracts. You can see their marks right there. These 3 contracts here on IWM, and these right here on SPY. And you can see that some of them are already starting to move where we want it to go. All right, so that's what TLT is done and XLE is done. And now we're into August, and we're not getting that big of a move today, so I'm not going to put on any new trades today. Steve, why not put a pending buyback at 5 cents? I mean, you can eventually put something like that, Steve, but if you can get 4 or 3 cents, you save a couple bucks, number one. Number two, you don't know, like, when do I put that on, because things can move. Like, I mean, as of yesterday morning, we were fine, right? We were fine on that, and so things can move. So I manage the trades, right? I manage the trades as they come during the week. I would have done, like I said, I would have done a lot of this yesterday, but I waited until class to show you the exits. I wanted to show you the exits on these trades as I was doing them. All right. So we're done with, and there's no trades in August. Like I won't do any today in August. We have a really small range, not much of a move. Volatility is not moving very much. In fact, volatility is relatively low. Here's what we'll do today. To take advantage of this lower volatility right now that we have, and then we'll close up shop for today. Let's sell the 278 and sell 284, and we'll do a few of these contracts, and then we'll come out to September, and we will buy the 278, and we will buy the 284. So this is a double calendar, right? Double calendar, double diagonal is what they call it here. Let's analyze this trade and come here to risk profile. And let's hide positions and look at that trade. and it is set slices to break even. Okay, so lower probability, but remember, if volatility rises, look what happens to my probability. That's the point of this trade here. The point of this trade is to take advantage of any potential moves to the downside. Now, we're not expecting big moves to the downside. We're just expecting potential rise in volatility because of seasonality. We're going to do a small position that will give us some positive vega. That's what we'll do today to take advantage of the low volatility we have right now and the looming seasonality of increasing volatility. Okay, so we get some positive vega in our trade. So we'll throw that on the SPY. Let's see what we can get here. We'll try 275. See what we get. Okay, so there's the trade that we'll put in, and we'll get filled in on that sometime today, by the end of today, and I'll make sure I take a screen capture of it in the filled order segment and put it in the forums. All right, that wraps us up for today. Today's inventory, and a nice close-up shop on July, and continue to build into August. We got a lot of room to build into August, and I did not put that into the August. Dang it! Haha, I can now. So, we got a lot to do between now and August expiration to build into that inventory. We got about 10 more days or so left. So we'll see if we get some bigger moves and take advantage of that heading into the middle of August. Thanks as always for spending your time with me this morning. Hope you got some good value out of that. Remember to tune in to Brandon's class later today on Strategy Lab, and then I'll be, his Q&A tomorrow, and then I'll be on with you tomorrow afternoon for our portfolio management with ETFs class. So as always, have a great evening if I don't talk to you again, and we'll see you next time. All right, goodbye everybody.